Hey guys, I have a question for you. How do you spread abundance? This year, Joe and I are spreading even more abundance by giving out insights on money, wealth strategies, and resources in our current newsletter, Creating Abundance in 52 Weeks, that we want to share with you for free. So sign up right now as you're listening to this episode on our website at www.abundantculture.co. That's .co/newsletter. www.abundantculture.co/newsletter. Don't let delay get in the way of your abundant year. Now, back to the episode. Welcome back to Abundant Culture Podcast,
where we dissect the mindsets and tactics of the true beasts of business.
People like Gary Vee, Grant Cardone, and Warren Buffett.
All to create a blueprint to experience life more abundantly. Hey everybody, it's Joe here. Welcome back to the Abundant Culture Podcast. We're so glad to have you back again this week. Today we have a special podcast episode for all of our real estate investors out there. You know, when you guys are really out there doing your job, you're making a lot of money. You have properties that are appreciating in value, you're depreciating properties, and guess what? When you sell, Uncle Sam is going to come knocking at your door for every single dollar that he is owed. And that could be a problem in your whole wealth building plan. So in order to combat that, we found that this thing called a 1031 exchange, and it allows you to exchange one property for another property and defer not only your capital gains tax, but your depreciation tax. Now, some of you probably don't know what any of that means, and I promise you we're going to get into it in this podcast episode. So get ready to listen to and learn from our good friends, Alex Strovsky and Michael Brady.
Hi, Michael and Alex. Thank you again for coming on to the Abundant Culture Podcast. We are super excited to have you because we haven't talked about 1031 exchanges on the podcast yet. And I know you guys are already a wealth of knowledge just by LinkedIn alone. But before we get into that, we have to ask you your backstory. Like, how did you guys get into this business, into this industry?
I guess I'll start. Thank you for having us on. This is great. I'm thrilled to be here. I know Alex is too. So this is Mike Brady. My profession is I am a dirt lawyer. I'm a real estate lawyer. I've been practicing law for since 1994. It's a long time now. And one of the first things I ever worked on was a 1031 exchange. The partner I worked for at the time, I was wet behind the ears out of law school and didn't know much. And he said, we have this great project. We have this client that wants to do a 1031 exchange. I said, great. What's that? He said, I don't know. It has something to do with taxes and real estate. Go figure it out. And back in 1994, the internet was still kind of expensive and not widely available. So when he said hit the books, he meant hit the books. So I actually had to go to the court library because we had no tax treatises in the office. Went to the court library and I dug around. I found the tax code and I dusted it off and coughed and sneezed and opened it up, found section 1031 and I read it. And I read it again. And I read it a third time, and I still had no idea what a 1031 exchange was. And after many billable hours that we couldn't charge the client later, what I discovered was I needed to find a good qualified intermediary to walk me through the process. And by doing that, we were able to have that client exchange a 5-family house in Jackson Heights, Queens in New York. And they bought a building lot out on the east end of Long Island in Southold and probably made a ton of money if they developed that lot and ultimately sold it. And then during the course of my career, I did a number of exchanges for a bunch of different clients and then had the opportunity to join a company in 2005 to act as a qualified intermediary. And I ran the East Coast for a national qualified intermediary for many, many years. Since then, I've been at another company or two and joined Madison about 2 years ago to head up sales and marketing for the company and to kind of oversee some of the structuring for our clients' transactions.
Awesome.
So I think, first of all, I like that we're dating this podcast because you still, hopefully in August, it's not going to happen, but you see some of my coworkers walking around with masks. So safety first here, which is very, very exciting. It's like people might be looking at this later on saying, what was the thing called? Corona,
Right.
what?
Right.
Yeah, let's hope so. Let's hope so. But just my background is a little different. I like, Mike, I think this is the first time you called yourself a dirt lawyer.
Dirt lawyer, yeah. I've called myself that before.
Yeah, I don't know. We've done a lot of these. This is the first, so I'm kind of trying to play off that. I guess I don't know what I was, but I guess I was a clean caterer. I guess I built a large catering company in Silicon Valley that serviced Fortune 500 companies, including Google and Facebook, and it was a very hands-on business. So I understand the small business mentality. I understand this idea of coming from a place of being a W-2, W-9 employee, and actually building a business which is an asset, something that can give back to you again and again. So my background is from a small business standpoint and also from social enterprises as well. I had the privilege of teaching about entrepreneurship in a lot of prisons and employing a lot of individuals second chance employment. So I knew a lot about that world as well. So I had the privilege of being in a lot of environments and cultures which I don't think people get a chance to explore. So I'm very grateful for that. And a point came where I had a chance to actually, I moved to Israel with my whole family. And our company has a very large office here as well. So what happened is I was looking for an opportunity to join a company and already understanding investment assets from being a small business owner, and being an entrepreneur at heart. This was a really natural fit because as we'll learn, one of the things that is important for people to do is build multi-generational wealth. And I think there's no better tool. Definitely, this is a tool everyone should know about if they're looking to build multi-generational wealth. So again, we want to try to escape the matrix, and 1031 exchange is one of those tools that can get you out of that W-9 mentality.
Are you saying that 1031 exchanges are like taking the red pill?
I forgot which pill we're talking about, Mike, and then I was like, I should probably not go with that. Just forget about it.
I think it was the red one.
I don't know.
I think it was the red.
Yeah, I think it was the red
No,
one.
the 1031 gets you out of the matrix. That's what we're doing here.
Yeah, that's the one.
We'll talk about how to get out of the matrix, but it definitely gets you out of the matrix.
For sure.
Awesome.
So for our listeners and our viewers who may not necessarily know what a 1031 exchange is, what exactly is a 1031 exchange? Because I mean, the neighborhood I grew up in and the family I grew up in, if I said 1031, they would have no idea whatsoever what that is. And I didn't know it until I was like pretty much a full grown adult. So could you explain it in kind of like Barney style, what a 1031 exchange is?
Yeah, I'll start off and Mike will take the baton. So I got the sock puppets here. I'm joking. Not gonna do it. I think, Mike, we should really just do a sock puppet 1031 exchange.
Yeah. That'd be our last podcast.
It's like, I think they might have to take away your bar exam. I think they're gonna defrock you. In short, the concept is quite simple. Every investor out there has a silent partner that they may be aware of, or they may not be aware of. But every deal that you go into, there's a silent partner that's at the closing table with you. And every time that you cash out of a real estate deal, that partner comes to you and says, it's time for you to pay me a percentage of my profits. Now, again, who is this partner that we might not be aware of, but he's playing a very important role in our life? Well, that's the government.
Yeah.
Right? The government is every breath you, in the words of Sting, every breath you take, he'll be watching you. So he's there playing a role with every single deal. And the reality is, at the time of if you sell a property and it's appreciating value, meaning you bought a property for $1 million, and then 2 years later, 3 years later, or 5 years later, it's appreciated to 1.2, 1.3. Well, there's going to be a capital gains tax you're going to pay on the appreciation. So the appreciation is really, really important to understand. And this capital gains tax, when the government gets involved, they get involved very seriously. So it could be up to 35% between local, city, and state, and federal. So but what the federal government did, they said, we want to continue people investing funds into the market. And what we'll do is we'll create a 1031 exchange, which allows you, if you reinvest money into the real estate market within a short period of time, you're going to be able to defer capital gains, right? That's what a 1031 exchange does. Now, Mike, do you want to go in a little bit more of the details, or Jasmine, do you guys want to ask any questions before we just jump into a little bit of the details?
Oh, we could jump into more details.
Yeah. So it's important to understand also that 1031 exchanges and this concept of deferring gain has been part of the tax code since the 1920s. So this is not some loophole. It's not some fly-by-night scheme like, you see these things all the time, that's illegal for the federal government to charge you federal taxes, right? It's unconstitutional, right? Which is not true. Totally not true. But there are schemes out there, and that's not what this is. This is part and parcel of the tax code. This has been established by statute, by case law, by regulation, a bunch of guidance from the IRS and the Treasury. So it's something that's part and parcel of our tax code. And essentially, it all lies on the concept of a swap of one property for another. So if Alex and I each had a commercial property that the other liked, and we traded deeds, that's automatically a 1031 exchange. And the idea is that because there's no cash changing hands, we should just be able to continue our investment without having to pay taxes. It's essentially, we're just moving our investment from one property to the other. And since there's no cash available, how would we even pay the taxes, right? Nobody's writing a check, and so there's no money available. So that's kind of the concept. Now, that doesn't happen very often where two parties just like each other's properties and, their interests align. So they created a third-party structure using a qualified intermediary. For tax purposes, the taxpayer is going to do an exchange or a swap with the qualified intermediary. And that's what our company, Madison Exchange, does. We act as a qualified intermediary. So what happens for tax purposes is the taxpayer gives us their property, right? We then sell it. We take the proceeds from that sale and we buy a property from somebody else, and then we give that property to the exchanger in exchange for the one that they gave us. So they've received property for property, and the money has flowed through us. Now, this would be a very cumbersome transaction if we actually had to do that, right? We'd have to have two deeds on each side of the transaction. And I joke a lot, we're part of a larger company called Madison Commercial Real Estate Services. And one of our sister companies is Madison Title. They offer title insurance services. And of course, they would love that transaction. If there were two deeds on each side of the transaction, two sets of title policies, a lot of the guys that we work with day to day, they would love that. Two premiums, two commissions, four altogether. So, and also on top of that, you'd have multiple recording fees, transfer taxes, closing fees. All these things, maybe not brokerage commissions, but still you see that the costs would add up. And so the Treasury permits us to do direct deeding. So it's sufficient if we as the intermediary take assignment of the benefits of both contracts of sale and the money flows to us, and then it's treated as if it was a swap with us for tax purposes. So it tends to be a very simple transaction when you put it all together, but the concept is that it's a more, complex transaction involving, a swap between four parties, essentially.
That's really cool because I never hear anybody talk about how it actually works. They just say the concept is like, oh, you trade one property for another and you defer your capital gains. And it's like, that's good enough for me. But I never heard the actual mechanics on what goes on behind the scenes and how that actually works. So is there ever a situation where a 1031 would not be advantageous for somebody? Or is it something that because it sounds like something that everybody should use all the time when they're selling a property, but I just wanted to make sure for our viewers and listeners that were there any times where it's like it might not work for whatever?
I'll let Alex cover that, but it's important. If you like paying taxes, then 1031 exchanges are not for you. But other than that,
absolutely. If you're that patriotic.
So essentially, there are definitely cases where 1031 is not advisable. I know. And a good case that a lot of people are not aware of is when you have no taxes to pay. That is one case.
Yeah.
So you'll be surprised that we'll have people reach out to us. They've heard about the 1031 exchange and they say, well, I want to reinvest my money into the market, but their property has not appreciated in value. Well, that's not a good case for to do a 1031 exchange. Again, if you've appreciated value, if your property has risen in value, or you've depreciated your property so much over holding the property for say 20 years, and now your basis is much lower, then it's a good idea to look at a 1031 exchange, right? So these are the kind of the two different levers. Either your property has really gone up in value, or over the years, every year you take depreciation on that value on the property, and then there's going to be recapture at the end of that. Meaning the government is going to come back and say, I want 25% still back. Well, you might want to do a 1031 exchange there. So that's one really important case to, again, if there's no appreciation, then you want to make sure that a 1031 is probably not a good idea. The second thing, which is really, we have this, people are always asking, like, I'm going to do a 1031 and I'm going to do a quick flip. Right? It's just very popular. So it's like, I've watched something on the Property Brothers and TLC. I've seen that Scott Disick, whatever his name is doing it. All the cool kids on TV are doing flips. I want to be a cool kid too. Let me do a 1031 exchange. So that would not work, because the 1031 exchange works for the purpose of investment and not sale. So an investment, you have to show that you have purchased this property and your intent is to be an investment and rent it out. So if your intent is to flip it and sell it in a profit in 3-4 months, well, that's not the intent of investments. In that case, it's not going to be such a good idea for you guys to consider. And the third thing, which is kind of obvious, is if it is your own home, it has to be an investment property. So if you want to sell your own home and you want to do a 1031 exchange, first of all, there's a much better exemption that's available to you. It's called a 121 exemption, which wipes out actual tax appreciation. But again, you want to make sure we're only talking to people who have an investment property that's appreciated in value or has depreciated. You've taken depreciation for many years and you want to defer the capital gains, right? So that's for the purpose of investment. That's a good 1031 exchange. And by the way, that covers many, many, many people, right? Anybody who is serious about investment is going to be in that bucket.
Awesome. Now, you mentioned something that I think a lot of people usually don't talk about when they're talking about 1031 exchanges. I always hear when people say, if it appreciated in value, you might want to consider a 1031 exchange. But a lot of people don't really talk about the depreciation aspect of it. Mm-hmm. So if you don't mind, would you mind explaining what depreciation is and what depreciation recapture is for our audience and our viewers?
I kind of want to hear the dirt lawyer's opinion on this.
I'll have to put,
I'm never going to let you down on this. That's it.
I'm going to have to put my tax hat on and put my shovel away. Or maybe, actually, tax lawyers use shovels too, I think. But so essentially depreciation. Everybody should be familiar with depreciation. If you've ever used your car for business purposes, you write off a portion of the value every year, okay, as a tax deduction against your income. The same thing applies, and that's because the car is worth less every year. Yeah. The same thing applies to real estate. So if you have a residential property, you can write off the acquisition cost, what you paid for the property, or at least a portion of it, over 29 and a half years. Okay. And if you have a commercial property, it's over 37. So you can write off, if you bought a property for $1 million, usually you cannot write off the value of the land. You can only write off the value of the building. Let's say the building was $700,000. Well, each year, if it's residential property, you get to write off 1/27th of the value and take that as a deduction against your income from the property. Okay, so it's a very powerful tool. And if you do a cost segregation study, which is kind of outside of what we're talking about, you can even accelerate that faster and take a much more front-loaded deduction. You get more bang for your buck in the early years of owning the property.
Yeah.
The downside of doing that is that when you sell the property, that depreciation has to be recaptured. Okay, so in addition to the capital gain, which is your profit, now your basis is reduced, and that portion that you've depreciated, that gets recaptured. The real estate portion gets recaptured at 25% typically. And to the extent that if you've done a cost segregation study, any of the personal property would be written off or would be recaptured at your ordinary income tax rate, which is even higher than the capital gains tax rates.
Oh, wow.
Okay, so, and that's why 1031 exchanges are very, very beneficial if you have a highly depreciated property. If you've owned it 15 years and you've written off most of the value, it makes all the more sense. You probably have more capital gain as well.
Yeah.
And so that's why 1031 will defer depreciation recapture as well.
That's awesome. So it's basically, to put it in like super down to earth terms, the government was like, oh yeah, you don't have to pay me today.
Right.
And then you sell your property and they're like, hey, you remember all those times I said you didn't have to pay me? Like, yeah, you
it's
kind of
like,
got to pay me now.
It's like that, the character on Popeye, I forget his name, right? It's like, I'll glad to pay you tomorrow for a hamburger today.
Oh yeah. Oh yeah. Yeah. I used to love that show.
Yeah, but yeah, essentially that's true. It just gets back. You're all these tools. You're deferring essentially paying the taxes until some future point.
Awesome. And another thing a lot of people talk about is the fact that you can't just like flip houses using 1031 exchanges all the time, because like literally the government would probably never make money off of anything ever again if people could legally do that. What is the rule on that? Like, is it like a certain time that you have to hold the property, or is it the intent that you had going into the property? Like what's kind of the rule for like what's considered like a flip and like an investment property?
So the property has to be held for investment rather than resale. Okay, so property that's acquired for resale is not eligible for a 1031 exchange. And so there's a number of factors. There's really 9 factors that the case law has looked at. And that includes things, I won't go through all 9, but the big ones are, what was the intention when you bought the property? Did you intend to fix it up and flip it, or did you intend to rent it? What was the purpose at which the time of holding the property at the time that you sold it? If you had a 15-unit apartment building, and you owned it for 10 years, you could do a 1031 exchange on that. If you took that 15-unit apartment building, you condoized it into 15 separate units, and you sold them off as individual units, well, now you've converted that into property held for resale, arguably. Okay, so you should not do a 1031 exchange on that. So those are some of the factors, but the most evident one is the one that we're kind of talking about, which is the holding period. Because when you file a tax return to report a 1031 exchange, you fill out it's Form 8824. If anybody is bored enough to look that up, you look at the form and it asks you, when did you acquire the property and when did you sell it? And if both of those years end in 20, it doesn't take the brightest bulb at the IRS to figure out maybe this is a transaction that's being held for resale rather than investment. Maybe we should look at. So holding period is the most evident factor. That being said, there is no set holding period. It is the totality of those factors. It's just a short holding period may get you audited easier than the other factors. So by and large, advisors would suggest that if you held the property and you rented it or use it for business purposes for 2 years or more, that seems to be the home run. Okay. And there's a bunch of stuff in the tax code that 2 years seems to be the magic number. There's some advisors that say if you held the property for as little as a year, and let's say you rented it out solidly for a year and then sold it, now you're talking about long-term capital gains rates kick in after you own the property for a year rather than income tax rates. And so it's deemed to be a long-term hold for some purpose. But there's also something that I like to call the Godfather defense. Okay. Which is you buy the property in January, and you rent it out. It's a solid, 7 months. And in July, you get that offer you can't refuse, right? Maybe it's somebody makes you an offer that's twice what you paid for the property. How are you going to turn that down? Or maybe the buyer has some other leverage over you that makes it physically prudent for you to sell them the property, right? That offer you can't refuse. Maybe you found a horse head in your bed, after you refused to sell it to them or something like that. But regardless, so you had other reasons for selling it. Your intention was pure. Your intention was to hold this property for investment, but other circumstances change. And even though you have the short holding period, I think you have an argument to make that, circumstances change, and so we should not necessarily be prohibited from doing this. And there's some case law that's not exactly on point there. The case law that's out there most recently deals with people who did not sell their property in a 1031 exchange, but they exchanged into a property and basically converted it to their primary residence after a number of months. And that's a facts and circumstances test. And in some cases, those investors clearly did not have a pure intention because they did things like listed the property for sale the next day, or they moved into it 2 months after, and sold their primary residence the day after they bought the property. But then there are other people who really made the effort to rent the property out, and after 7 months just couldn't do it. And so they had to sell their primary residence and they moved into it. So those are some of the factors that they look at.
Awesome.
Okay. And then can one of you go over like the time frame that you have to like find a property, and then if you don't find anything, then like what happens?
Yeah, so essentially there's a few timelines. The first timeline starts before the sale, right? That's just because the first thing you want to make sure after you speak to your accountant and make sure that there's a benefit of doing a 1031, or call Mike or I and we can kind of talk through that conversation with you as well and give you some advice. The first thing you want to do is contact the QI, contact Madison 1031 and have us be there, because before the sale, we have to be the ones who receive the proceeds of the sale. So that's one timeline that's really important. We get calls all the time, and it gets a little sad. I'm not a therapist by nature, but we've had some tears being shed of people saying, look, I want to do a 1031 exchange. And we ask them, when is the sale coming up? He says, well, I already sold it. Well, you sold it, we can't do a 1031 because you already received the money and it's not taxable. So the Uncle Sam is now knocking the door instead of the 1031 guys. So that's one timeline you need to be aware of. The second timeline is you have 45 days to identify a replacement property. So you want to make sure that the property you sold was $1 million, right? It's a beautiful $1 million. You want to make sure that first all the money is reinvested, because anything that's not reinvested into 1031 will be considered what's called boot. Why it's called boot, I don't know. But it's called boot, and it's going to actually be taxed. So people are typically trying to reinvest all the proceeds into the 1031 exchange. So they have 45 days, 45, to identify properties they're going to be replacing. And typically what we advise is if they choose 3 properties, then they can choose a property of any value. So again, if you're choosing up to 3 properties, you can have one property of $1 million in New York, one property of $1 million in Texas, one property of $1 million in California. There's no problem, there's no limitation. And then where you're going to go after, and then you have 180 days from the time of sale to close on one of those 3 properties. So it's simplest when you have 3 properties. If you do more than that, there's special rules that apply and we can discuss them. But essentially, you are identifying properties for 45 days. At the end of those 45 days, you cannot go on the 46th day and you've had one of those you've had those fall away. You can't go back. This is I think share. Michael, is this share? If I could turn back time, if I could find a way.
I believe it is share. Yeah, I believe it is.
Well, guys, you cannot turn back time. You cannot find a way to go back after the 46 days. It's really very, very clear. So, and that includes, weddings, bar mitzvahs, weekends, capital holidays, disasters like Corona make a difference in the timelines we can talk about. But usually 45 days are 45 days. And then 180 is a strict 180. And then during that time, 45 days, you find their placement, 180 days, purchase a property, and your 1031 exchange stands the test of time.
Yeah, I was really looking forward to you singing. I thought that was next. But
I thought it's going to be the fishnet stockings. That's what I thought you were looking forward to.
Not going there.
This is a bit of Mike. I feel like this is a very interesting atmosphere for us at this podcast.
It's very loose today.
We're really buttoned down. Like you're in a shirt. I'm wearing a shirt. Like this is nice. You guys just put everybody at ease. I guess it's that. I don't know. Just feel nice and tingly together.
Great. So what should someone look for in a 1031 intermediary? Like, are there any like qualities that you're supposed to look for?
Sense of humor. No.
Okay. That works.
Yeah, so it's important to understand what we are and what we aren't. So this term qualified intermediary. So in 1994, when I heard it, I said, oh, thank God, I found somebody who's qualified to do this work, because I clearly wasn't. And what I discovered is, yes, the people I worked with were very, very helpful and qualified. But the term qualified intermediary does not mean that anybody's qualified. There's no special training. There's no qualified intermediary school. There's no good housekeeping seal of approval that you get from the IRS saying that you're qualified. What it means is you're not disqualified. Okay. A disqualified person cannot be a qualified intermediary. So who's disqualified? Well, it's case by case. So it depends on the party's relationship to the taxpayer doing the exchange. So no agent of the taxpayer can act as their qualified intermediary. That includes their relatives. It includes any employees that work for them. It includes any other agent relationship, such as a real estate broker or agent, investment banker or broker. their accountant, or their attorney. Any of these people, if they've provided other services in the 2 years prior to the exchange, cannot be their qualified intermediary. So that means really anybody else can be their qualified intermediary. And we are largely an unregulated industry, which is important to note. There are a handful of states that do have some regulations. They typically direct what types of bank accounts can be opened. That's typically the limits of it. They may require bonding and insurance. We have all those things. So you want to do some homework, and you do want to ask questions. Number one, you want to know that the QI has some expertise in the area, right? It's not somebody who just woke up and decided that they wanted to be a qualified intermediary. If such a creature exists, you want to make sure that that's not what happened here. You want to make sure that they know what they're talking about. So we belong to a group called the Federation of Exchange Accommodators, which is our trade group. And it sounds like something out of Star Trek, right? The Federation of Exchange Accommodators. But essentially, it's our trade group. They have a code of ethics. They also have a proficiency test. So you can be certified as an exchange specialist. You take a test demonstrating that you know the rules and regulations, and you have to actually be in the industry for 3 years before you can take that. I am a certified exchange specialist. We have 2 others on staff as well. We also have 3 attorneys on staff. We work with accountants as well. So you want to know that there's some knowledge there. Additionally, the most important question is, well, what do they do with the money? So we're handling, millions of dollars, billions probably as an industry on behalf of our clients. And so we are very conservative with the money. We only put it into escrow accounts that, and we can set up segregated escrow accounts that bear the taxpayer's name and tax ID number, so it's identified as their proceeds. Okay, we don't do anything speculative with the money. So that's the next most important thing. And then you want to see that they're bonded and insured, as well, which we have all those bells and whistles as well. So those are important questions to ask.
Awesome.
So you have been a wealth of knowledge so far, and we want to start wrapping up to respect your time and also the time of Zoom.
On the free plan.
Yeah, exactly.
Yeah, I see the clock.
So the question we wanted to ask next is, whether it be in you guys' personal lives, in your business, where you're employed, or even in your spirituality, how do you choose to spread abundance?
Yeah, that's a great question. So, I've always taken, and Alex as well, have taken the position in our business that we're here to serve the real estate community. We always want to be a resource to share our knowledge. And we always say that if somebody has a question, and even if it's not a transaction that we're involved in, we're more than happy to answer those questions and kind of walk people down the garden path to help them. So that carries throughout my life also. I've always kind of tried to give to my community and to my family, and so I've coached soccer over the years for the kids. I did that for a very long time. Now I'm very active with the pandemic. I'm very active in some groups, providing mutual aid to the community for people who either are having trouble with food resources, or some people who are shut-ins that can't shop and get out. And so that's kind of my current focus. I'm also involved in climate change and some other issues where we're trying to affect change through lobbying, et cetera. And that's just an important part of my life. And it's kind of how I kind of try to spread, abundance, which, that's it.
Thank you. That's amazing.
Mm-hmm.
Yeah, I think for me, I think one thing that's been important to note is that I had my first child when I was 23. And I have 3 children, and the oldest is 9. So that kind of dates me. But I think that abundance has to start at home. I know Mike puts a tremendous emphasis on raising amazingly good children, and I think there's a lot of it's tough. Being abundant at home is tough because I've always had these dreams of working in some remote village somewhere, and because I think those people really appreciate it, but sometimes the people who you give most to, the ones who appreciate it least, that's sometimes the kids. So I think for me, my challenge is something that I try to embrace is how to bring abundance to my children and my spouse, and that's with certain practices, some of the spiritual practices like the Sabbath. For example, on Friday night to Saturday night, we are digitally detox. We don't use, try to do our best to limit electronics. And I'll say that about marriage, people forget often that their spouse is their business partner, and they put so much emphasis on their business dealings. But remember, just be aware of this, that if you're not sometimes the best business decisions, I hate to say this, to make sure that your family is taken care of as well. So keeping that family abundant with your attention and love as best as you can. And everybody is trying to do their best right now. That's all I can say. Everybody's doing the very best that they can under the circumstances. So that's, I think, a place where I'm trying to put more and more emphasis is how do I bring abundance and legacy to my family.
Awesome.
I absolutely love that.
Yeah, beautiful answers.
Yes.
So let's say there's a real estate investor listening to this podcast right now, and they know that they really need to do a 1031 exchange, or maybe it's another person on another podcast listening to it, and maybe they want to interview you as well. How do those individuals get into contact with either you guys or your teams?
Sure. I think the easiest way to reach out for me is LinkedIn. So I found a lot of connections through that web. So LinkedIn, Alex Jandrowski is, just comes off your tongue, Alex Jandrowski. And Mike M. Brady at Madison1031.com. Or Mike is also very, very, very active on LinkedIn. Also, our website as well, and blog that Mike writes regularly is a good way. But sometimes you could just close your eyes, and if you think hard enough, we'll just appear.
Put your heels together.
Yeah, exactly.
So this has been an awesome episode. Usually, this subject could get really boring, but you guys have a lot of humor, which, everybody listening, make sure that your intermediaries have humor, like Alex said. So we just really want to thank you for coming onto the podcast. This has been a blast, and we learned a lot too, and I'm sure our listeners learned a ton.
Right, and if I said anything controversial, I was misquoted. I just want to put that out there.
Absolutely. Don't hold it against some folks.
Right.
Yeah, exactly. Thanks for having us on. This has been fun.
Thank you.
Guys, and thank you for your service, guys, also.
Thank you. We appreciate it. So that's all we have for today, folks. I hope you got as much value out of this as we did. Keep in mind, the only way we can improve is through constructive feedback. So remember to rate and review this episode. Also, you are not the only person that needs to know this super valuable information. So be sure to subscribe and share as well. Stay tuned for the next episode. And remember to always spread abundance. Peace.